Hi, everyone. Welcome to the Canadian Passive Investing Show. I'm your host, 𝗖𝗣𝗶 𝗖𝗽, and I'm joined by my co-host, 𝗖𝗪 Biniaz. We have another great show for you today. Please like and subscribe as it helps us build our channel and allows us to keep bringing you great content and expert guest speakers. Our mission here at CPI is to empower investors to create financial and time freedom through passive real estate investing. And today we are joined by Jesse Fragale.
Got it.
Welcome, Jesse.
Welcome, Jesse.
Hey, everybody. How's it going?
Great.
Now, Jesse is a commercial real estate broker and investor that started with student rental properties at the age of 19. As his passion for investing grew, he started investing in single-family homes and condos. Then he transitioned into multifamily apartments. So today he focuses on operating and raising capital for commercial real estate. So we believe Jesse's going to bring immense value to our audience to make strategic investments in real estate. So Jesse, let's just jump right into things. If you could start off by telling our viewers a little bit about your background and your involvement with real estate investments, please.
Yeah, no problem. And I'll try to hit that high bar there for you guys. I got started in real estate in college or university. Bought my first rental property, went to a university in Waterloo. It's about an hour and a half west of Toronto. If there are US listeners, it's kind of Canada's Silicon Valley. So a lot of good entrepreneurial spirit out there. And yeah, my first investment property was while I was in school. I saw that I was living with a friend that his father and him went in together on the property that I was actually living with. So I saw myself and friends of mine paying rent to another friend and started to realize that it was a great area to invest. And I kind of had a somewhat of a background in that my father, who's also extremely entrepreneurial, and my mom as well, they had a family friend that had a number of single family investment properties. So at a really young age, I'd always ask, what does Mikey do? He doesn't have a job. What exactly does he do? And that kind of got ingrained to me really young. So long story short, that's how I got into it. This is probably now I was 19, 20 years old. So we're talking about '08, '09. So you don't think of '08, '09 as when you're going through it as a significant time, but looking back, obviously we know now it was a pretty historic time for the economy. And going back that far, what I was doing was reading Canadian Real Estate magazine. If you guys remember that magazine, there, Bigger Pockets, I think, was in its infancy. There weren't resources everywhere. That was my first property was $250,000 student rental property with 5 female tenants that I pretended were a lot younger than me, but I really was young and trying to figure it out.
Great. Yeah.
Fantastic.
I guess timing is always important, right? They say luck, if it's in a mathematical equation, is when timing meets opportunity. So you jumped on it. That's great. And also another item is here in Canada, I mean, a lot of information and content comes over from the US, where you could buy a home in Texas or Arizona or Florida for $300,000 or $250,000, and you can rent it for around $2,000 a month. So you're already cash flowing from the day one. But in here in Canada, especially in the larger cities, Vancouver and Toronto, the rent to value ratios are very low. So that and the kind of also the entry level to get into a single family home is very difficult as well. So talk to us about early on in your career as you were starting in real estate investing, how did you overcome that particular hurdle to with the high mark of the high bar of entry, with the low rent to value ratios, and also the rigid mortgage laws. Our mortgage laws are much more difficult than the US. So go over that.
Yeah, it's funny. I just jumped off my podcast with a mortgage, commercial and residential mortgage broker, and we were talking about some of the differences with Canada and the US. And we have the portability of mortgages. Talk to an American, foreign concept for them. 30-year fixed rate, they have that, foreign concept to us. So 100%. To your point about Toronto, Vancouver, I think I say those things together in every sentence on my podcast that we're talking about expensive markets. At that time, the property, I know it just offhand because you always remember your first property. The gross rent was approximately $2,400. So $250,000, $2,400 in gross rent. So, if you go use a 50% rule as your expense ratio, pretty decent property. If you found those type of numbers today, especially in our markets, you'd jump on them. So it was still relatively affordable in certain markets outside of this, like the downtown cores. But yeah, 100%. It was something where you really had to go look for value adds. Student rentals, still to this day, the valuations are a little bit different. Cap rates are a little bit higher. You can find those deals, but they're becoming harder and harder to find. So, whether you're in New York, you're in San Francisco, you're in Vancouver, Toronto, you really need to think outside the box. You need to start looking at, the quote 18-hour cities, or the cities, towns, hour, 2 hours, maybe more outside of your general area. But I was lucky at the time, 08, 09, there were still a bunch of deals that were still in our Canadian market. And to your second point about the mortgages, I think at the time I was in the 5.5 fixed percent range. And back then, if you guys remember, 5% down was still pretty doable, 10% down. Now, when it came to student rentals, there was only a few banks that would lend on those. So that's where you had to start, getting more creative with the financing. But at the time, I think it was 5 or 10% down. I went to my dad and asked, so I had a little bit of cash because I worked summers. I said, listen, this is an awesome investment. Do you want to sign on this line of credit so that I can purchase it? Gave him the numbers. He said, absolutely not. My parents were divorced. So what does a kid do? He goes to his mom and says, Dad's not signing this. So for me, that's kind of how I got my first start. And I always tell this story because I feel like people, when they talk about how they got started, it's always fuzzy. How did the money happen? And I just like to say that everybody, you go to the resources you have. I don't come from a very wealthy family, but they gave me every opportunity. Family, predominantly immigrants, very entrepreneurial. But what that allowed me to do was she signed on the guarantee for the line of credit, which added to my down payment, which allowed me to get the space. And then when the second one came around, because I continued to invest in student rentals, then I had a case that the next one, when I partnered on one of them with my father, I could say, hey, this is how the business has been doing for the last 1.5 or 2 years. So that's kind of the background.
You build that track record, and you were lucky enough to have parents who helped. I guess one of your parents.
He was like, finish school, then we'll talk.
There you go. Yeah.
And you were 19 years old, so right?
Yeah, I was just turning 20. Like when I put the offer in, I was 19. When it finally closed, I was 20.
Great. And if you could expand on, when you talk about student housing, is that the building or the unit or the home is zoned for student housing, that you can't rent it to regular tenants, kind of idea?
Yeah, so it's a good question because it used to be anything that a student occupies. And then what started happening in a lot of cities in the States and in Canada, you would have either municipalities or cities mandate that you have a student license. We're all big fans of the government, and it was basically, a tax that you had to pay to have it licensed. Now, I'm not saying that there isn't good logic for it. There would be, fire code, additional things you would have to do to meet that standard. But it was also kind of like, a taxi, the medallion system where, they only would, in this particular case, they would only give so many of them out. So, that's how they were kind of categorized in Waterloo. And I know in other areas in Oshawa, I still have a couple student rental properties where towns are kind of talking about implementing that type of thing, but not all towns do. So that's how they'd be categorized as student rentals. Some were above board and some people were doing just, without the license.
Got it. That makes sense. Just getting back to your point, as far as making strategic investments, and you have to find the kind of diamonds in the rough for it to make sense here in Canada and Vancouver and Toronto. There are deals, but they're hard to come by. It's not a scalable business model. It's not somebody, in the US, somebody living in Texas making $100,000 a year, and they can buy a home for $300,000 and they'd be cash flowing from day one. And, if they do some small renovation and even keep the property, they can then in a few years just repeat the same process, buy another property and continually grow their portfolio. It's very difficult business model to to do here, and especially doing it part-time, having a job or a profession, and then doing real estate on a part-time basis to then find those deals, to be able to be an active investor. So that's another great conversation here.
So we learned about what started you in single family. Now I'm curious, what made you fall in love with multifamily, and when did you kind of start getting into multifamily?
How do you know he fell in love with it? Maybe he just likes multifamily.
Oh, maybe that's true. That's true.
We're madly in love. What happened was, so finished university, over that time period, I purchased, I believe it was 4 single families. So these were kind of spread out there. One was in Oshawa. So if you know Ontario, Oshawa and Waterloo, they're complete opposite ends of Toronto. And what started happening is, and I'm sure you guys are aware, Vancouver was similar, where pre-construction condos became a big thing. And this was 2010, 2011. I started to purchase those, and what, a lot of people call wholesaling now, or just assigning the contracts. I did a few times. So what I did was I kind of kept going down the student rental path. I appreciated a decent amount on a lot of these properties, and then sold them pretty much, not all at the same time, but pretty strategically, that I wanted to sell these and have a nest egg to move into the commercial space. It coincided with my job actually moving from working with the job that I got right out of school, to actually a friend of mine kept saying, listen, you love this real estate stuff. What are you doing in your current job? You should be in commercial real estate. And I finally got a job in commercial real estate for 𝗖𝗣𝗜 as a commercial broker. I happened to work in office leasing and investment sales, but it was kind of through that where you start really opening your eyes to see what people are doing in different areas. My partner, he also works for the company, but he also is an investor in the multifamily space. Multifamily, I think the reason I gravitated towards that is it's just more accessible for the smaller investors, that when they get their start. If you're going down retail, office, industrial, one or two tenants, you could really have a large vacancy. You need a lot of cash for tenant allowances, tenant inducements. And then the other thing is, in Canada, and I believe it's similar in the States, whether it's Fannie Mae, Freddie Mac in the US or it's CMHC in Canada, there are financing products that are more geared to apartments, because it's still considered residential, even though it's 5 units and larger, which a lender looks at that as commercial. So yeah, accessibility for lending. And yeah, that's how I made the transition. And we've kind of focused now just exclusively on building up the multifamily portfolio.
Great. So not only your focus as investing changed to multifamily commercial real estate, you actually switch your profession to also be involved in the commercial space as a broker. Funny enough, Ava and I were looking at a private equity firm and their principals, and just reading about their bios, and we noticed every one of the principals had commercial broker on the bottom of their title, even though one of them had a PhD, but he still had a commercial broker at the bottom.
At the very bottom, everybody was
of their bio.
Well, it's funny. There's a lot of people in our industry, and NAIOP's a great organization. If you're interested, especially in Canada, in commercial real estate, or North America, it covers all areas. But so many of the people that have started their own firms, that are CEOs of brokerages or workplace strategy, it's funny how further back in their career, a lot of times they were brokers or leasing specialists, and really seeing real estate from the ground up. And I think it's a good foundation as investors, or if you want to have a career in real estate.
Yeah, definitely.
Great.
You got your license. I had my license.
Yes.
We all had our license.
Yeah.
I couldn't wait to get rid of mine, but
likewise. I had mine for 10 years.
Oh, wow.
So now I want to talk to you about. Let me see. I had a question here for you. I want to talk to you about. We in our research, we're in the space we're in Canada, and in the real estate private equity, and especially thought leaders in this space who put out content. Obviously, you came on our list, and we noticed that you are a thought leader in this space. Talk to us about your connection with Bigger Pockets and how that came about. Especially one of my biggest complaints with Bigger Pockets is that most of their content and information is directed is for Americans, and a lot of people do read that information and now have wrong information or information that doesn't make sense. They believe that 1031 exchange exists here in Canada, or that they could, part-time be real estate investors and have 20 single family homes, or other compliance verbiage that's used in the US, which doesn't mean the same thing on this side of the border and means something totally different. Something like an offering memorandum is a document provided by a broker to someone looking to purchase a commercial real estate, where an offering memorandum here in Canada is a legal document, a securities exemption that's used, and it's a legal document. So talk to us about your connection with Bigger Pockets and how they came about, and what do you currently do with that group?
Yeah, for sure. I think it started from, I was on the podcast, the Bigger Pockets podcast, as a guest years ago. I think that was what started the relationship. I don't remember exactly how that relationship started, but it did then. And what ended up happening is we continued communication. Obviously, I used Bigger Pockets as a resource. And just as a side note, for Canadians that are on Bigger Pockets, even if you have a free account, you can go and put keyword alerts. And almost always I have one keyword alert that is Canada, Canadian, US, Canada. So like, you do get chats that are started specifically about Canadian investments. You're going to be pulled into those strings, which forums, which is great. The way I started doing videos for them, I think Brandon and we were talking, or I had reached out to him a little while after the podcast, and I'd said, you guys don't seem to have a lot of commercial content, whether that's, industrial, retail, office, larger apartment buildings. It seems to be focused primarily on single family and apartments. And I said, what if, would you guys be open to me doing videos? And he's like, I guess at the time they're like, yeah, absolutely. We're missing that piece. So yeah, for a couple of years, I was doing videos on commercial real estate, whether that's commercial loans, private equity. You're absolutely right, though, when you say that, there's that US Canadian gap, and 100%. It's, you have American or Canadians thinking that they should buy US real estate and put it in an LLC. Okay, Canada doesn't recognize an LLC. You have certain things like you're saying with the offering memorandum. You keep hearing they're raising money for 506C offerings. That doesn't exist here. So there's all these little intricacies that we need to focus on, that when we hear about this, a type of investment in the States, really need to figure out what that equivalent is up here. And that's what I think we were trying to do to a certain extent there. But like I said, ultimately, as a Canadian, there's definitely Canadians on the forums there. You just kind of have to search for it. But yeah, it's a really good point.
Great. Awesome. Talk to us a bit also about your own platform. So aside from working with Bigger Pockets, I believe you have your own YouTube show and podcast. Talk to us about that, the process, and how you came about, starting your show, and how is it going?
Yeah, no, it's going great. It's a lot more work, as you guys know, than you really realize when you go in. I was just, a friend of mine just sent me a stat, or a couple stats about podcasts, and it was, I can't remember exactly, but something like 3% of people go past episode 3, 50%, whatever it is. It's just the consistency. I'm definitely more active on Working Capital. That's my podcast. It's Working Capital, the real estate podcast. You can get that anywhere, iTunes, Spotify. And the YouTube channel, I just started putting out, like a lot of people, the questions you get asked again and again and again. A lot of times it's just easier to make a video, send it out, and say, this answers it. I think that being on the Bigger Pockets, realizing that, like when you go on their channel, it's like all of a sudden you have, 70,000 views on something, and you can't manage comments like that. So I think for me, it was just like, I didn't realize there was that many people out there that wanted this content. So I try to put stuff up on YouTube as much as I can, but really the focus for myself is more on the podcast side. And then through there, people can reach out to me, hear me on the show. And if it's about investing in the future, investing in other investments that we're doing, that we're raising capital for, that's where I would say the platform is, but it hasn't been formalized in a way where, you know, it's my day job, and that's what's challenging about it, right? I'm still in brokerage, and I don't think I'll ever leave brokerage completely. But yeah, that's kind of where I'm at right now.
Yeah, being a broker is like, you know, the bat sign put up in the sky. When that call comes in, you got to go. So,
Yeah. It's definitely a full-time gig.
yeah, great.
Yeah.
Now, just to touch on your podcast a bit more, what is the podcast mission statement? So, what problem are you solving? What message are you getting across? And what is the kind of the final call to action, or you know, the benefits it has, not only for obviously your listeners, but also for yourself?
Yeah, what I wanted to do is have an educational real estate investing podcast where we have guests on, we have them from a range of backgrounds, all centered around real estate. So, you know, whether that's a cross-border lawyer, whether that's a mortgage broker, whether that's talking to people that are investing in self-storage. I wanted to get kind of a round picture of what real estate is and the different niches, or as my podcast guests say, if they're American, niches. That drives me crazy, but the different niches in our industry. And through that, what I hope to do too is when I have people on the show, and you touched on it earlier, as a Canadian, even though half of the listeners are American, I try every time I can where somebody's like, well, an FHA loan, and then, okay, well, let's just clarify from the Canadian point of view, it's this. Or, you know, if they say something like 30-year fixed mortgage at 3%, and I say, well, in Canada, you can do a CMHC mortgage at 1.6. They're like, that's crazy. You 1.6? Because a lot of times you hear they don't believe that our cap rates are 2.9, 3% in some areas. Like you're in Vancouver, and guarantee some of those office buildings are sub 3. And they're like, well, our loans are 3. It's like, no. Your loans are 3. Our loans are not, even though it's still crazy low. So there's all these little like variations. So just a long-winded way to say what I try to do with the podcast is try to be a North American podcast where I can have Canadians and Americans listen to the show and feel that they're both getting talked to.
Great.
That's fantastic.
So now let's switch the conversation here. Eva has a few questions for you, but let's switch the conversation back to being a real estate investor. As we all know, eventually real estate investors run out of their own money because they've already deployed it, or they're looking for bigger projects, and time comes to raise private equity. Where are you at in your business currently? Are you at that stage that you're raising capital? And talk to us how that all came about, and we can go from there.
Yeah. So this year, or I guess the end of last year, starting of this year, is when I first started to raise capital for real estate. It's kind of a scary thing, which I think is a good thing. If you are a fiduciary to somebody else and you're managing somebody else's money, I think part of you should be a little scared. I think that's natural. You should have a fear of making sure that you're doing the right thing for your investors. So that coincided with a lot of the podcasts I listen to. And again, the guests that I've had on my show where, you know, you get connected to masterminds where they are teaching raising capital or fund to funds model, stuff like that. And again, it kind of goes back to your point of the offering memorandum where, like, you know, we sometimes call it an information memorandum. That's more of a brokerage thing than I think a US thing, but yeah, the offering memorandum in Canada, you're talking about legal documents. And the reason I bring that up is the mastermind that I was in was a US centric mastermind for raising capital. So even there, it's like, unless you're investing in the US, it's really challenging to justify what you're spending on that mastermind, depending on the cost. But anyways, that got me into the mindset of it, like buying your first property. Once you do it once, you're like, oh, that I can do that. And that's really what it was for us. Once we started raising capital, so this was the first investment, raised $1.5 million of equity. So it's not a huge amount, but it was the first time we ever raised capital, me and my partner. And, you know, the thing is, you go through these different cycles while you're raising. Oh, are we going to have enough? Okay, we're good. No, I don't think we're good. And then it got to the point where we're like, you know what? After it's all said and done, you have subscription agreement signed. You're like, I think if I was forced to, I think I could do 3. I think I could do 5. And I think that's the natural progression when you get used to something and you see that it's achievable.
That's fantastic. And Jesse, I'm curious, what structure do you use to raise private capital?
So we do a pretty standard limited partnership agreement. So general partner, limited partner, with the caveat of having a asset management company as part of basically the administration that kind of handles everything. So for those that don't know, the limited partners are all your investors. They have limited liability. This is not legal advice, but they have limited liability in these investments. The general partner in Canada, a partnership cannot own a real asset. They can't own a property. So you need to have sometimes a numbered company or a GP. The general partner, as a corporation, oftentimes owns the property, has title, but the limited partner has a beneficial ownership of the property. And then from there, Ava, we do a very simple split where you have a certain threshold of preferred return that goes to your limited partners. So return of capital first, a pref return of a certain percentage. Then after that, a profit split between the general partners and the limited partners.
Okay,
Great.
fantastic.
Yeah, and maybe you can kind of talk to us more about the deal that you had. So, for example, here at CPI, our business model is the multifamily value add, and because of the higher rent to value ratios that exist in the U.S. On a 70-30 LTV. We're able to, from the rents we collect, we're able to pay our mortgage payment, pay the taxes and fees, third-party property manager, and still have a surplus to pay our investors those preferred returns you talked of from day one, because the deals we look at are usually 90% occupied. So they're well above the mark. So now, how do you go about your deals? Are your deals ground up development? Is it a value add project? Is it kind of A class? Talk to us about what kind of deals you guys work on, and how are you able to? Is there a return given to investors from day one, or is there kind of a capital event where the project has to go through certain steps before there is any kind of cash flow coming back to the investors?
Yeah. So for us, constantly looking for off-market deals. As a broker, the first thing we think is that we're not bidding on deals. So for me, I was actually land registry, looking for properties off market, calling, hey, Jesse Fragale, listen, I want to put an offer in on your property. Would you consider one? So constantly outreaching for off-market deals, happened to find an off-market deal. A gentleman owned the property for a number of years. I think it was kind of retirement time for them. They were, ready to sell. So for me, this just happened to be a A-class deal. I wasn't searching for an A-class deal, but it was in probably one of the most expensive areas in Canada, in Forest Hill in Toronto. It just so happened that when we took a look at these rents, we just saw that it was probably at 60% of what market is. So initially, when we went into it, what we were going to do, and a lot of our clients do this, where they do what they call condo finishes to older apartments. So you're putting a dishwasher in the apartment, in-suite laundry. And what our initial thoughts were to go in, do $75,000 per unit, really higher end upgrades to achieve higher end rents. Now, COVID happens, and all of a sudden, you have to be careful about trying to just do A class when the market, might not be able to sustain it. So for us, what we did was we kind of pivoted and decided to do, instead of a $75,000 upgrade, maybe a 40, 45, more conservative rents, and then kind of, turn over 3-4 suites within a shorter time period. So the structure of the deal ultimately was, it wasn't a vanilla deal. It was a bridge loan for 2 years, stabilize the asset, do the renovations, renovate, lease at these higher rates, then switch to a conventional or CMHC loan. Switch to that loan once you've achieved that rent, so that basically the mortgage takeout takes out your bridge loan, and now you have a stabilized income. And to answer your last question, in terms of the capital event, this deal would be like a development deal. And if anybody has seen limited partnership agreements, when it comes to development deals, you get your preferred return. And just as an aside, a preferred is not a guaranteed return. It's a preferred return. And absolutely you try to achieve that. But in a development deal, there's no income. So what happens is that, say, 7% preferred return accrues. So year 1, 7, year 2, 14. Some people compound it. We don't. It's just simple accrual. And then when there is a capital event, say the refinance, then we decide, do we, pay investors all back their initial cash, keep them in the deal, Or do we sell the property? Has it gained enough that, it looks appealing to sell and pivot, or buy another asset? So that, we looking back, I would have had a lot less stress if we picked a more vanilla investment, but that's what we got our hands on.
Great. How many units was this project?
So this one was 7 units, but for anybody that's not in a major market, we're talking about 500,000 plus a unit. The some that have sold on the street are 700,000 a unit. So this is not, you're not in Boise, Idaho. The first apartment building we bought was actually west of Toronto in Hamilton, 11 unit, and it was a third of the price. So it's just a matter of, you can find more expensive assets, but there definitely has to be a value play there, because they're just too expensive to buy if they're already stabilized and at full rent.
Awesome. And the hold time, Jesse, what's the hold time that you guys were predicting?
For this one that we're purchasing. So this one, what we have is that 2-year kind of time frame to do the renovations. And then for us, really, we talk to investors. The partnership is open for, longer than that. But I personally, if things are where we think they will be in 2 years in terms of where we want to get the rents, I would love to refinance it, get everybody their capital back, and stay in the deal together. And then down the road, because of where it's positioned with a lot of over $1 billion of provincial funds in transit, I think we could add another story to it longer, in the long run. So yeah, we have a few options, but the reason I bring that up is I hate seeing these investments where somebody says like paying out their LPs and then buying them out. It's like, you're the reason they got this asset. You can pay them out and then they're not in the deal.
Totally.
Yeah.
Options are key. That's fantastic. Now maybe we can discuss your nurturing process for your investors, as it's obviously a very important component of syndicated investments. So maybe you can please tell us how you nurture your investors and get that know, like, and trust, and keep that know, like, and trust going.
Yeah, for sure. I can't remember. It was actually a guy in the West End, I think Saskatoon, I had on my podcast, and he said, it's very simple. He's like, listen, go on your phone. If you scroll all the way down, if you have an iPhone and your contacts, scroll all the way down to the bottom, you'll see how many contacts you have. It's actually crazy when you're like, how did I accumulate, whatever, 1,000, 700, whatever contacts. You can upload those to your computer as a spreadsheet, and you could run through those and really look at who is somebody that I haven't had in contact with that I could reach out to, not to sell them anything, but as a touch point saying, listen, how are you doing? It's been a while. Just a general email. So he had like a 3-step, general email discussion, and just not being salesy, and eventually basically telling people, listen, like, what I do in real estate. These are the type of investments that I buy. If this is something that you'd be interested at all, when we have one of these under contract or we're purchasing one, let me know if you'd want me to share it. And if you don't, just let me know as well. And 9 times out of 10, people don't say no. They don't say like, no, don't tell me. And you be somewhat strategic about the people that you're reaching out to. And then I think what people really need to do, you're in so many more networks than you think you are. For me, I did my master's at the University of Toronto, and just reaching out, literally getting the class list for my year and reaching out to all of them, because, if they did that in school, they're probably, doing something that, might be a little bit different. They've made a career change, maybe later in life. So you have access, I had access to a lot of people that were like, yeah, 100% sign me up. And some of the people that are in the subscription that are LPs were from that. So, I've had people on my podcast that were in law enforcement, and they left the force, and then they had their first syndication with 20 cops. So I think you got to look at the networks that you're in, and don't be afraid to tell people what you're doing. Like you two are doing here. People know when they talk to you, August and Ava, like, yeah, they're in real estate. So I think being seen is important. And I know it's not easy for everybody. We're not all extroverts, but it really is an important part if you want to attract capital, and that's the path you want to take.
Great.
Fantastic.
Awesome. And I'm sure your shows and your connection to Pockets is also a great cultivation process for bringing awareness to you and investors to your services. But maybe briefly touch on your nurturing process when investors do connect with you, if it's from your own list or from your marketing campaigns or from your thought leadership platform. As they come into your database, how do you keep in touch with them? If it's through newsletters or other content that you send to them, so eventually when you do have a deal, because as us being in the syndication business, we're not a fund, we're not continuously buying assets and continuously raising capital. We look for great deals and then we present it to our investors. So talk to us very briefly about your nurturing process for your leads or your contacts.
Yeah, absolutely. I think for me, part of it is, when you go to workingcapitalpodcast.com and people will subscribe to the podcast, that'll be part of, me reaching out to people and connecting and nurturing through there. When it comes to people that I've reached out to that say didn't sign up for the last syndication, just touch points with them, whether, Constant Contact or MailChimp, keeping them abreast of what you're doing. And really, I haven't formalized it in to a T. For me, it's just been, the list of people that I have that are in my database on, through my website, where we capture all the emails through the list that I have when I reach out to people. It's really like that right now. If we move to something more formalized as we continue, maybe that will be the path. Ideally, I'd like to get to a point where we're going to have committed capital rather than syndication, where you're chasing the deal, chasing the clock. Whereas where you can call capital and you have the fund there.
Yes.
And it's cool because you probably have a long list of people who are watching you on the sideline, watching you kind of do your first deal and then your next one. And eventually a lot of syndicators say 5 years down the road, they've been watching us and boom, they just gave me $2 million. So
yeah. Well, I had a buddy of mine, and really good buddy that I did that, was in my MBA, and he's like, he opted out of the deal, and he was just, you get a guy constantly asking questions, and then he's like, so did that happen? I'm like, yeah, it happened. He's like, okay, I'll go on the next one. I'm like, I told you, man. So yeah, you just keep in touch, and yeah.
Yeah, and it seems your process is much more up close and personal and hands-on.
Yeah.
So that's always the best way to go about. When companies get bigger, you never even get the CEO on a call. With your case is very kind of up close and personal. So that's great. That's great. Awesome.
All right, now Jesse, time to have some fun.
All right.
We're going to start the next segment of our show. So we like to call this the 10 championship rounds to financial freedom. So please just tell us the first thing that comes to your mind, and I'm going to get started.
All right. I'm set.
All right. So who was the most influential person in your life?
Whew. Oh, I'm going to get one of them mad. Probably my father.
He didn't give you the money, man. Come on.
He is. You're attracted to the hard to get.
What is the number one book you recommend?
Oh man, so many, but I'll just say start with No, Jim Camp.
Okay. If you had the opportunity to travel back in time, what advice would you give your younger self?
Start early, start right away.
You started at 19, man.
I think just in general with other things, like anything in life that you go, I'll do this, oftentimes you don't do. So just jump in. If you will regret not doing it. That'll be the heavier regret when down the road.
Totally.
Awesome.
All right. What's the best investment you've ever made?
In my education.
What's the worst investment you've ever made?
Let me think here. Worst investment I've ever made. One student rental property. It's tough to call them the worst because you learn from those, but a lot of mistakes made on that took a while to fix, and yeah.
All right. How much would you need in the bank to retire today? What's your number?
Nothing. I love being active and working, and I don't find what I do, a job. So
it's a great answer. If you could have dinner with someone dead or alive, who would it be?
Well, dead's more fun and morbid. Probably Milton Friedman. The Economist. I've always found his writings really good. Capitalism, freedom, free to choose. Yeah.
Awesome. If you weren't doing what you're doing today, what would you be doing now?
That's a good question. Probably law.
Okay. Book smarts or street smarts?
I'm after all my education, I'll still say street smarts.
Okay. If you had $1 million cash and you had to make one investment today, what would it be?
I would put it in a fund as the GP's capital to show our skin in the game, and whatever we can multiply off that with investors.
Awesome. Love
Awesome.
it. That was
That's
great.
a wrap. That was great answers.
Awesome. It's great. Yeah, those are so yeah, you don't get asked those every day. That's great.
Yeah, there you go.
Yeah,
Kind of puts you on the spot, and it's fun putting someone, first thing that comes to mind.
Educational as well, right? It helps others kind of think about these questions and kind of helps them with the process. Hey, Jesse, we really appreciate your time.
Really
Thank you for taking, we know you're super busy. We really appreciate you taking the time, coming and speaking to us. It definitely added a lot of value to our viewers and eventually our listeners when we change this show to a podcast. Thanks, man.
And yeah, Jesse, if you just want to take a quick moment to tell everybody what the best way that they can reach you, please.
Yeah, for sure. Aside from Google search, Jesse Fragale, workingcapitalpodcast.com. You can go there if you want to subscribe to get the show, or Spotify, iTunes, and reach out to me there. I'm as a broker, I'm not hard to find. So that's
Fantastic, Jesse. Thanks a lot for coming today.
Thanks so much.